In this lesson, we want to take a look at how can I actually recognize fake structural breaks and how I have the probability a little closer on my side. To do this, we will go to a chart, namely the US30. Of course, this also applies to any other asset, to everything you see in trading. The question you ask yourself is, how do I recognize a fake structural break? We're not doing a top-down analysis now. We're just looking at the chart section here. What we see here is that the market is slowing down and making a few smaller movements after an initial long structure. And here, the market suddenly makes a lower low at H4 and will potentially have a structural break right here. The question that arises now is that a valid structural break or could it be a fake out? There are two things you can watch out for. Firstly, these are structural breaks that may only happen with a very small wick or shadow. These are usually very dangerous and you should avoid them. You should be very careful here. It didn't actually happen in this case because the following candle was also bearish and broke this low. We have another huge problem here. The problem, look at the market. We are in an absolutely strong bullish market here. We've been running like mad and this is the first structural break we've had. And the first break against such a momentum, you should always look at it very critically. Because we will learn the big players out there need liquidity above all to move the market. And how do they get liquidity? By using us as fuel. They try to trap you to make you believe that there is a break of structure so that you enter short and they can take your stop loss to buy more positions. If in doubt, go with the trend and question the first break of structure you see. And wait until a second structural break appears because you don't have to be the first in the market to make money. You just have to be in the right direction. Let's look at the result of this break of structure here. We see that the market just keeps running and running and ignores this break of structure. If we would have gone short here, we would have just have been liquidity for the big players to move further along in the market, as you can see here. So how do we act in such cases now though? You should always ask yourself after such a long movement whether this one structural break is enough for you to go against the big market. It would be best if you wait for 2 or maybe 3 structural breaks. And then you can go against the momentum. Because the momentum usually lasts longer than you think, as you can see in this case here. In the next video, we will then look at how you can determine the order flow of the market so that you always know in which direction the big players are heading in. And you therefore can be in the same direction as the big momentum in the market. See you later.